This video we continue with Chapter 3, Accrual Accounting and Income, Learning Objective 3, How to Adjust the Accounts. So adjusting entries, or AJEs, adjusting journal entries, are basically done to make sure that our revenues and expenses are recognized in the same period. Recall our matching principle, where we match expenses with the revenue in which it was incurred. Usually adjusting entries are done at the end of the accounting period, so monthly, and the key here is that the adjusting entry has one income statement account and one balance sheet account. Now remember, revenues and expenses are on your income, and your balance sheet is your accounting equation. Assets equal liabilities plus your owner's equity. So, which accounts need to be adjusted? So here we're looking at our unadjusted trial balance, which is what you print. It basically shows your debits and your credits, which they must equal. And then you look at it to see what accounts would probably need adjusting. So as we start looking through that, there's three categories: deferrals, depreciation, and accruals. Sometimes depreciation is also referred to as estimates. So you have accruals, deferrals, and estimates. So a deferral basically is you're adjusting a payment of an item or receipt of cash in advance. So a common deferral is prepaid expenses and or unearned revenue. So now we come back to our account here, and oops, sorry, let's go there. Oh, we're going the other way. Now in depreciation, what happens here is we're allocating the cost or the usage of the plant asset, which is the expense, over its useful life. For depreciation, you need to note that you have a historical cost that you pay, and then with that historical cost, we have historical cost, which is the price you pay. Then you have salvage value, which is what you expect to have at the end of the asset. Most companies, we use zero. We don't expect the asset to be worth anything after its useful life. So for example, you might have automobiles in your business, and you might say that their useful life is 5 years. Lastly, we have an accrual. So an accrual is opposite of a deferral. Remember, deferrals were prepaid expenses or unearned revenue. Whereas now, an accrual is what you are, it's a deferral. So you're actually accruing usually expenses. So you're adding expenses before they're paid. And you're also might be accruing revenues before you collect the cash. So prepaid expenses, very common, I would say, is rent and insurance. And here what you're doing is you're paying an expense in advance. So don't get confused with the word expense, which we know is on the income statement. A prepaid expense is an asset. And basically you're paying that in advance. So you're taking one asset, which is usually cash, and you are converting it into another asset, which is prepaid expense. So now we're back to our Freddy's Auto Service, and we prepay 3 months of store rent, which is $3,000 on June 1st. So this entry to record the prepayment would be, always think about what's happening to cash. Is cash going up or down? Great, cash is going down, right? And so we're going to debit prepaid rent for the full $3,000 because that's what we paid, and we're going to credit cash. And our relating T accounts at the bottom here, we're going to see a debit to prepaid rent, an asset, and a credit to cash. So now, this was on June 1st, so now we have this prepaid balance, but at June 30th, this is the end of the month, we have to do our adjusting journal entry to show that we actually need to record rent expense for $1,000 because 1 month has gone by. So in this case, we are actually going to debit rent expense for $1,000, but be careful here. We have to credit prepaid rent. So in this case, we are crediting prepaid rent. We're not paying cash again, and don't get confused here. And remember, always think about what happens to cash first. In this instance, we're not giving out any cash. Therefore, you don't reduce the cash. You'd reduce prepaid rent. So now you see we have $2,000 representing now the rent for July and August that we paid. So now on June 2nd, we paid cash of $700 for cleaning supplies. So in this case, we're going to increase our asset account supplies and we're going to decrease our cash account for the $700 that we paid for those supplies. Now, again at month end, at June 30th, we now know that $400 of that supplies remain on hand. So we had $700 in our account. So what we know here is that we're going to have $400 at the end. Therefore, we need to record an entry for $300. So we need to credit our $300 here. So in this case, we have our $300 that's going to supplies expense. And then let me remove this here for us. Now you see the $400. So be careful, pay attention to what's happening because we need to make sure that we are only, since it says we have $400 on hand, that's what we need to have at the end of the month. So we needed our entry to be $300. Now you go ahead and do this particular example and make sure that you understand what's going on. So at the beginning of the month, we have again supplies for $5,000. And during the month, here we have $7,000 that were purchased. So at the end of the month, we have $3,000 on hand. So if we do this in the form of a T account, let's just enter supplies here. At the beginning of the month, we have $5,000. During the month, we purchased $7,000. And at the end of the month, we have $3,000 on hand. So that means we have $12,000 minus 3. So we know we have to book an entry for $9,000. So in this case, that's exactly how we came up with the $9,000 here. And then our ending balance is going to be the $3,000 just like they told us. So let's now move our attention to depreciation of plant assets. Plant assets are long-lived, tangible assets, long-lived meaning greater than 1 year, and build land, building, furniture, and equipment. Remember, land is not depreciated. So there's no depreciation on land. So what we do is we record the asset when we purchase it. And then with the exception of land, again, land is not depreciated. It will decline. The asset will decline in usefulness. We do record a depreciation expense. And then depreciation is where we're allocating the cost or usage of the asset to the actual, we're reducing it. So we're allocating the cost that, hey, it does cost us to use this asset for this year, so we have to reduce the value of the asset. So now if we purchased equipment on account for $24,000, is anything happening to cash here? No, right? Because we are purchasing it on account. So if we're purchasing equipment, we're going to debit equipment for $24,000. And we are going to credit accounts payable. Remember, payable are to vendors, receivable are to customers. So in this case, we purchased something, so we are actually recording it as a payable. And here you see we're debiting our T account for equipment, and we're also crediting our T account for accounts payable. And let me go back to that. Equipment, remember, increases on the debit because it's an asset, and accounts payable increases on the credit because it is a liability. So if you recall, assets equal liability plus owner's equity. Assets increase on the debit, whereas liabilities and owner's equity increase on the credit. We have debits equal credits. So the equipment is expected to have a useful life of 5 years and then be worthless. So this is our salvage value or residual value. It can also be called residual value. And then one way to actually get our depreciation is we take the cost of the asset, $24,000 in our previous example, and then we're going to divide it by our expected useful life. This is known as straight line depreciation, and that gives you an annual depreciation, and then you convert it to monthly. So here you're taking the cost and you're dividing it by the useful life. And this gives you annual, and then what you take is you do the annual amount and divide it by 12 to get your monthly amount. Remember, adjusting journal entries are usually done at the end of the accounting period, which is usually monthly. So let's record depreciation expense. An expense is a revenue, it's an income statement account, and it increases on the debit, so we want to increase expense for $400, but here is the new account. We are not going to credit equipment. The only debits and credits to equipment are when you purchase it and you sell it, right? Those are your debits and credits. On this end, you're purchasing equipment, and when you're crediting it, you're selling equipment. The usage of depreciation, that is considered a contra asset account. So if assets normally have a debit balance, your contra asset account normally is going to have a credit balance. So here we're going to take our $400 depreciation expense and we're going to make sure that we record that to our contra asset accumulated depreciation account, not the equipment account. Don't make that mistake. This is not equipment. You're not crediting the equipment, you're crediting accumulated depreciation. So what happens is that the accumulated depreciation account shows basically all of your depreciation expense. This account balance increases over the asset's life. And don't forget, it is a contra asset account with a credit balance, okay? And if you, let's take into consider, a contra account has a companion account and it's the normal balance is opposite. We have accumulated depreciation as a contra asset account, and we also have allowance for doubtful accounts or uncollectible accounts. And that is a contra asset as well, and that usually goes, the companion account for depreciation is equipment, and the companion account for accumulated allowance for doubtful accounts is accounts receivable. And we'll talk more about that in subsequent lectures. So the book value is how much is left. So where you take the cost, in this case $24,000, minus our accumulated depreciation thus far, then you have a net, and so here you have your book value of all assets. Notice we added land here, and there's no depreciation associated with land. So now our book value of our plan assets is $41,600. So if we're looking at this situation, what will be the book value of Freddie's equipment at the end of July? Notice this is June. And if we recorded $400 for 1 month of depreciation, we're going to do that again in the next month. So in this case, this number would become $800, and our total number here would be $23,200, and then in this case, we would have $41,200. So, and in here we'll see our modified Starbucks, all of their assets. Remember, land is not depreciated. Leasehold improvements are items that you do to your lease. Maybe you replace the carpet, you do some remodeling. Then you see that Starbucks would have quite a bit of equipment, coffee equipment, and they have furniture and fixtures, the tables and the chairs, etc. Now, for accrued expenses, here what we're doing is we're saying this expense was incurred, but we haven't paid the cash. Normally, the most common are salaries, interest, and taxes are the most common at this end. So here, we're paying our employees a monthly salary of $1,800, half on the 15th, and the other half on the last day of the month, which for June is the 30th. So now assume that if this payday falls on a Sunday, Freddie pays his employee on the following Monday, which would be July 1st, which would be in the next accounting period. Therefore, we have to record in June's books the expense. So we paid the first half. So here when we paid it our first half, we made the following entry. When we pay the employee, we debit salary expense and we credit cash. We paid the employee on the 15th. So right here, this entry goes for the 15th, and you see our T account basically shows the debit to salary expense and the credit to cash because we paid it. But now, since our second half or the other $900 are not going to be paid until July, we need to book an adjusting journal entry. So we're going to debit again the salary expense for $900, but in this case, we're going to credit salaries payable, which we know when we see the word payable, that is a liability account. So now we still show the full $1,800 here as expense in the month of June, and then we're okay. So now accrued revenue, that's what we've earned, but we haven't yet collected. So here, normally, if you perform a service at the end of the month, but you haven't yet billed the customer, you're going to bill them, so hopefully you'll get your money in the following month. So here, if FedEx hires Freddie, and FedEx is going to pay Freddie $600 monthly with the first payment on July 15, but during June, the key word, Freddie will earn half a month's fee of work for the work that it performed from June 15th through June 30th. So at June 30th, what Freddie has to do is say, hey, I'm going to get $300 from FedEx. FedEx is my customer, so this is my accounts receivable. And then I'm going to credit my service revenue because I actually performed the services on their FedEx trucks. And you'll recall from our previous chapters, these are the beginning balance, remember, or the balance carrying forward. So here is your debit to accounts receivable and your credit to service revenue. Remember, revenue is on the income statement and accounts receivable is part of assets equals liability plus owner's equity. It's an asset and it's on our balance sheet. So now we will stop here and let you perform this exercise. Okay, now moving on to unearned revenues. Here you get money now, but you just haven't performed the services, so you have unearned revenues, which is a liability account, right? So sometimes you might get work customer deposits, you might actually purchase airline tickets, but they're not expensed until you actually go and get on the flight. So here, if we have Home Depot that actually contracts Freddie to perform oil changes on their trucks, and what Home Depot agrees to pay Freddie $400 beginning immediately, but then if Freddie collects the first amount on June 15, but he hasn't yet done the services, he's going to record the cash, but then he's going to record this liability account of unearned service revenue. And remember, liability is something you owe, so Freddie owes Home Depot their services. And now on June 30th, what has to happen, which is the end of the month, we know that our unearned service revenue account with a $400 credit, but then during the latter part of the month, they earned 1/2 of that, or $200. So this adjustment is now recorded to debit unearned service revenue and then credit revenue. So in this case, we know that the $400, we earned $200, so we're going to have to reduce this to get to our $200 balance, and then we're going to add $200 in our service revenue. So these were all of the adjusting entries. So this is a very good way to remember everything. These next few slides shows you exactly what you have to do when you receive the cash and you record the asset, and then when you record the expense. And then for unearned revenue, again, you're getting cash and you're showing unearned revenue, which is a liability, and your recording of the liability. So make sure that you have these entries in your memory bank so that you can easily determine when to record these adjusting journal entries at the end of the month. Now, accruals is basically cash that's happening later. So here we have to accrue the expense, and here's when we pay it. So obviously we're crediting cash. Again, this entry is important. You should have it memorized. And then accrued revenues is we're actually accruing the fact that we're going to get money. And then when we do get the money, we have to remove the receivable. And that's accounts receivable. So basically, we want to measure income. Remember, there are two purposes. We have an income statement and a balance sheet account. That's why we're doing it. And then every adjusting entry records revenue or expense, and it has the income statement account or a balance sheet account, and then it affects an asset or a liability account. So here's our adjusting process. So we want to know prepaid expense, what's debited and credited. Remember that we talked about depreciation as a contra asset account, accumulated depreciation. So the previous entries in the first few slides, this is the type of account that it impacts. So here's our adjusting process again. Now we want to make one other adjusting journal entry, which is to record the income tax expense and the income tax payable. So at this point, we're showing our $600 of income tax expense and our payable. So please make sure you understand all of these journal entries and their amounts and how they came about. Notice we always list the debit first, the credit, and this is a simple description of what the journal entry is trying to do. And here you see all of the T accounts after we printed our unadjusted trial balance, we produced our adjusting journal entries, so now we have these T accounts. And then what we get is our adjusted trial balance. So basically, this is where you produce your financial statements. So we have unadjusted trial balance, then we book our adjusting journal entries, and then we have our adjusted trial balance, which we produce our financial statements, and we know our income statement is first, our statement of retained earnings is next, followed by our balance sheet and our statement of cash flows. And here you see this is the unadjusted trial balance. Our debits are adjusting journal entries and our adjusted trial balance. And notice how all the debits equal all the credits. So now you could go through this illustration. We'll pick up on our next video right here.